Right, good morning, folks. My name is Peter Armitage. I'm the CEO and co-CIO of Anchor Capital. This morning, we're very proud to bring you our Where Will the Money Be Made seminar. We're going to hear from 4 of our high-quality fund managers and analysts, give you some perspectives. It certainly started off as a very interesting year, and there's going to be a lot of work to do as we navigate our way through some choppy waters that we're anticipating. So we're going to start off with Nolan Wapenaar. He's our co-CIO, and he's going to take us through some economics and the fixed income part of the market. Over to you, Nolan.
Good morning, everybody, and thank you very much for dialing in. I'm just going to introduce myself for a few seconds here. I notice on my screen that a number of people are still logging in. The number of participants is ticking up very quickly. So I'm just going to drag out the introduction a bit, and then I'll hop into my presentation. As Peter introduced me, I'm co-CIO along with Peter. Ultimately, I'm responsible for everything that pays interest income as opposed to dividends. So it's going to be my pleasure today to talk you through Anchor's views on bonds, both domestic bonds and foreign bonds. And then I'm going to also talk about our views on the Rand. I see the number of people is still joining is still ticking up, quite quickly. So just give it a minute or two. And while we do that, I'm going to at least put my presentation slideshow on the screen for you. Okay. We're still ticking up. So in terms of where the money will be made, I'm going to jump into it now. I wanted to start this presentation by looking at something a little bit different. It's almost by the end of this year, it's going to be 3 years since the pandemic started. And what I wanted to look at is how different countries, how different economies have fared through the pandemic. So what we've done here is we've looked at the size of the economies of various countries at the end of 2019, so just before the pandemic became real. And then we've looked at the IMF forecasts for the size of those economies at the end of 2022. So it's kind of 1 year of pandemic crash and then 2 years of recovery. And what you've really got is the Chinese economy, starting on the left, is going to be 116% odd, 117% larger than it was in 2019. So through the pandemic and the recovery, the Chinese economy has effectively grown 16%. And you can see the growth rates for various economies. Interestingly, the world economy on average has grown by about 7% through the pandemic through to where we're at now. But there are a couple of takeaways from this graph that I just want to touch on. And the first is, if I look at the winners, the countries that have sort of exceeded the world average, the USA, China, and India, this is not an emerging markets or developed markets discussion. Actually, both emerging markets and developed markets, some economies have come through stronger than others. The other point is right on the right-hand side, we've got South Africa, which is by the end of this year going to basically just recover to where it was. I think the IMF numbers for South Africa are probably a little bit on the low side. And if we normalize those numbers to where to what Anchor's views are, actually what you get to is South Africa, the United Kingdom, Mexico, even Brazil and the Eurozone are pretty much neck and neck and all recovering and coming out of this at about the same pace. So maybe it's good news that South Africa is coming out of this at the same pace as many of our developed market and emerging market peers, although I would love to be on the left-hand side of this chart. But as you look at this, what you've really seen is a world where 2020 was massive negative numbers in terms of recessions, and you've seen significant economic growth last year, and you're going to see significantly above trend growth this year. And that then speaks to our asset allocation views. It's this above trend economic growth that gives us confidence to say that we continue to be in a pro-risk environment, in an environment where risk assets should perform well. So naturally, our stance is to lean towards equities, and we prefer equities. So if we look domestically at our asset allocation views, we've maintained our positive stance towards domestic equities, and we've increased our stance towards domestic listed property from neutral to positive as we're getting better view transparency on the expected sort of earnings for these companies. Globally, our favored asset class also is equities and bonds, slightly less positive because the prices are a little bit higher, but still preferred asset classes. And against that, what we've got is domestic bonds where we're neutral because we think that the expected return of 9% is quite attractive. However, it's just a case that we think you probably will get a little bit more juice from equities this year. And then offshore, we're quite negative on fixed income instruments. And I'm going to talk you through those views now and then hand over to Peter Armitage. I also point out that we talk about the rand being marginally stronger, and I will touch on that. But before we go into that, just looking at the world that on 1 January, the world we walked into for 2022, there were two crowded trades that I just want to touch on, and I want to touch on what that means for our asset allocation views and what it means for investments for the year forward. And the first crowded trade was that everybody on this planet knew that global interest rates were going higher. Everyone was expecting US bond yields to trade higher and is positioning as such. Now that's great because when the crowded trade is there, because what you see is that creates a trend. We are seeing a higher interest rate environment trend across the globe. The thing with the crowded trade, and we saw this actually in about April last year, is these trades can reverse very quickly. So, at some point in time, somebody decides, I've had enough of this, climbs off the bandwagon, everyone has the same idea at the same time, and you can actually see very significant whipsaw effects in the market. So where does that leave us? Well, basically what I'm saying is we think that, the trend for now is rates are going higher, but you've got to be careful. It is going to be a volatile year, and that is going to apply across all asset classes. The other crowded trade actually at year end is every research I picked up basically was talking about, as US rates go higher, as the Fed hikes rates, the dollar is going to strengthen. You've got to be long dollars. You've got to be investing in dollars. And that is part of the reason why the rand actually pushed to 16 to the dollar as at 1 January. That trade already feels like it's losing a little bit of steam, but certainly it's a sort of theme that we've seen playing through the markets, which we need to be aware of because that's going to again create some volatility as we go through 2022. But looking at our rand views firstly, and the rand views are actually quite challenging this year. So on the left-hand side, I can argue for a stronger rand. And one of the arguments would be that, we expect that once the Chinese Olympics are complete, I think they start on the 4th of February, we've got the Winter Olympics. Nobody wants to do Winter Olympics in the middle of smog and under a cloud of pollution. So you switch off all your iron ore production, etc. Your kind of factories stop working, you clear the air, you have the Olympics, you turn them on again. So we expect a ramp up in demand for commodities. At the same time, the Chinese economy might have done very well in the last 3 years, but it's starting to look a little bit sick now, and we expect stimulus, again, positive for commodities. That's going to help the trade surplus in South Africa. It's going to help our trade balance. We're going to export more. That is rand positive. The other point to note on the bottom left is that in December, Fitch Ratings unexpectedly upgraded South Africa. In fact, I had to do a double take when I read it, but they moved us from a negative rating to a neutral rating. And really what that means is that a lot of the actions that government's been taking, we've spoken about things like the fiscal consolidation. We've spoken about slowly working with business to regain trust and credibility, etc. As all of these factors are playing through, the rating agencies are kind of looking at South Africa and going, maybe this is going to work out a little bit better. Maybe there's a little bit of trust in the system, and they've stopped downgrade. They've moved us from a negative outlook to a neutral stance. That doesn't mean we're getting better. It's not a positive stance, but it's more a bit of a sort of sign or a leaning that we've stopped going backwards. So from that perspective, if this trend continues, I think there's a lot of positivity. What if Moody's upgrades South Africa as well after the February budget? So those are the positive stories. On the right-hand side, the concerning stories, the negative stories are that interest rates are going higher. And as the Fed reacts to the high inflation and raises rates and sort of cuts stimulus, there are going to be fewer dollars in the system. And that means that, the emerging markets should come under pressure. South Africa is an emerging market. And there is a reasonable prospect of a bit of a liquidity pressure on South Africa. That can hurt the rand. Historically, that has hurt the rand. And then President Ramaphosa faces an ANC elective conference at the end of the year. Lindiwe Sisulu is clearly very aware of this. And that means we are going to see a more random than normal political environment, and generally politicians speaking without really thinking about the economic impact is bad for the economy. So you can expect that there are going to be some own goals this year. How does this all play out? Well, it's a tough one. If I look at the factors on the left, the positive factors, a research note from Wall Street drifted across my desk last night saying if I focus on those and the potential weakening of the dollar, where I get to is 12 Rand to a dollar. And I sort of looked at that and I shake my head, but that's the one extreme. On the other side, if I focus on the negatives, there's a bank in South Africa that put out a research note focusing on those, and they're calling 17 Rand to a dollar. So I guess those are the maximum parameters. Within that, though, Anchor sticks to its purchasing power parity model, which basically says that over time, the rand should appreciate with the US against the dollar by approximately our inflation differential. The inflation differential is going to be quite narrow this year. I think South African CPI at 6% right now, circa there. US is probably going to be pretty close to that as well. It's 7 right now, but it'll come down a bit. So where we're at is our models are basically saying the rand is probably neutral against the dollar for much of the year, bearing in mind it's going to be a very volatile period. So what was our view? Historically, we've said the rand in the sort of 14.50 to 15 range. I think that range continues to hold. We think that certainly for the first half of the year, you're more likely to be towards the top half of that range. And that means for the purpose of all our modeling now, we're actually working with a rand dollar of 15 Rand to a dollar. Interestingly, at the time we published this, the rand's at 16. It felt very aggressive to be talking about 15 Rand to a dollar. Last night we were 12 cents from there. So we're talking about a lot of rand strength if you read our models, but that's from a different starting point. From today's starting point, really what we're saying is the rand should bumble around in its current level in a volatile but sideways type environment. But now turning towards global bonds, and if we look at global bonds, the point is that interest rates are going up. We've had that discussion. How far is really the debate? And I think that depends on two factors. Firstly, what inflation does, and secondly, how the US Federal Reserve reacts to the inflation. So if we look at inflation in the States, it's running at about 7% right now. But we can break that down into its different components. And what you will see is services inflation. So in other words, restaurants, travel, that sort of stuff is actually still running slightly below where it was pre-pandemic. So makes sense. I mean, people aren't going to restaurants as much. People aren't traveling as much yet. Similarly, food inflation is actually running slightly above where it was pre-pandemic, but not too meaningfully so, not too worryingly so. So those are the two categories that are less concerning. The categories that have been driving inflation are firstly goods inflation. So what we're talking about is people wanting to go out and buy something like a car. So hence I've got the secondhand Ferrari up there. And what has happened is chip shortages, because you can't get enough electronic chips to put into the car to make the car, means that there's a car shortage. And if you need a car, you need a car. So you go and buy secondhand if you can't find new. And secondhand car prices have been going absolutely ballistic in the US. I think, quite easily up something like 70% from where they were 2 years ago. That is creating a lot of goods inflation where people are sort of competing to buy items that they need, which just aren't available. Why aren't they available? Because you've got supply chain blockages. So your factory in China that makes components for your car might be under Chinese lockdown right now. You can't get the components, you can't make the car, can't sell the car, and people are then forced to compete for the few cars that are out there. That phenomena continues to drive inflation in the US. And our view is that, look, China China's got Omicron lockdowns right now. But our view is that this should abate over time. So we see inflation from goods kind of remaining quite drastic, quite severe. But by the end of the year, we think that that starts to normalize. Looking at the picture on the right, the other big driver of inflation is energy costs, fuel costs. And your price of oil has, again, this year pushed up. I think it was about $88 a barrel, partly on Ukraine fears, etc. But this energy, which is naturally a very volatile item within your inflation measure, has been pushing inflation higher. So these are the two factors pushing inflation higher. The thing is, both of them tend to abate. So what we expect to see is an environment where the Fed will see interest rates pushing higher or inflation pushing higher. It's going to be uncomfortable. They're going to need to hike rates. But come sort of August, September, you're going to start to see inflation rolling down and the Fed will calm down a bit. It's going to be a sort of season or a year of two halves. Right now, we're in a world where people are competing to see how high they can project the US interest rate. So it was going to be 2 interest rate hikes this year, then 3. Then suddenly analysts were jumping on 4. Now I've had analysts talking about 5 or 6 rate hikes. And while this is going on, the mentality continues to feed into rates are higher. Where does anchor come out? So what you've got here is a chart that shows the blue line, which is where the US 10-year interest rates were over time. And against that, the red line, which is where anchor thinks the US 10-year should be trading. You can see much of last year, we were probably expecting higher rates than we actually got. This year, we've moved our rate expectation to 1.9%, which is actually directly in line with where inflation or interest rates were prior to the pandemic. So we think we complete the normalization, we go back to where we were pre-pandemic, and we think that a lot of that movement has already taken place in the first few days of January. But that US bonds, while this narrative continues, you're in a situation where US bonds are paying you 1.8, 1.9% interest income, but there is significant risk that yields are going to push higher. So our perspective on US fixed income is that bonds, we remain negative on bonds. Globally, bonds are quite expensive. They've got negative real interest rates. Their yield is less than inflation. And right now, the path of least resistance for bond prices globally is lower. And that means that, we just think there are better investments out there. So hence the negative stance on global fixed income. Looking domestically, South African bonds are actually quite cheap today. So what we've got here is a chart that shows you South African, what is priced into South African bonds in terms of interest rate hikes. And the way to read this chart is to say that by the 13th of February, the financial markets expect South African interest rates to be 0.25% higher. Basically, South African markets are saying that the Reserve Bank is going to hike rates next week. If we jump to after the next meeting, you can see that the rates go up a bit. So the market expects another interest rate hike. If you look at the gray bar, what it is saying is that in a year's time, the market expects interest rates to be 2.25% higher. So the market expects 2.25% of interest rate hikes over the next 12 months in South Africa. The thing is, I totally agree interest rate hikes are going to take place, but if I look at the economists, they're all talking about interest rate hikes of about 1%. So you've got this massive disconnect from financial markets that are projecting 2.25% interest rate hikes and economists that are projecting about a 1% interest rate hike. Our view is that the reality, again, may lie somewhere in between, but it probably lies closer to what the economists are talking about. Therefore, from our perspective, what we think is that you're going to get your 1% of interest rate hikes. It's probably going to be front-loaded. So you may have one at this meeting now, another one at the meeting in March, and then sort of following on, and then they'll pause a bit. But at a 1% interest rate hike, and the market is over its skis, it's too aggressive by about 1.25%. We think that the market will need to back down from this. And therefore, South African bonds are cheap. They're trading like value instruments. You've got a great yield. You can invest at 9% yields, and there's potential upside from capital gains. The only factor we need to be aware of, though, is rising global rates. So what I've got here is a chart of South African bond yields over time, and that's the red line on top. And I've got the US bond yield, also the 10-year bond yield for both over time, and that's the sort of blue band at the bottom. In between that is a gray band, and that really is the difference between the two. The point I want to make, though, is if you look at this difference between the two, when you get to the right-hand side here to sort of 2020, you can see during COVID, what really happened was that the difference between the two widened out. The basis between the bonds widened out tremendously. And then last year, as US rates started to creep upwards, really what's happened is the difference has narrowed down. So in the year of great interest rate normalization, we think that this differential will actually sort of normalize as well, go back and trend back to historic trends, which means that, yes, there will be headwinds from global bonds. We fully expect that. However, a lot of those headwinds will actually be absorbed just by the difference between these two sort of normalizing again. And therefore, we actually are in a position to remain positive on South African fixed income. So pulling it all together, where will the money be made? Domestic fixed income bonds are cheap. The yield of 9% is actually very attractive. There's a potential in the longer term for capital gains. We've just got to accept that there is going to be a headwind from global bonds, and that means it's going to be a little bit of a bumpy ride. Still, however, an attractive asset class. Love the Anchor BCI bond fund. I'm going to end my presentation there. I'll be back for questions at the Q&A session, but I'm going to hand over to Peter Armitage to take us through Anchor's equity views.
Okay, I'm going to talk through how we're feeling about equities, and certainly a very interesting year in prospect. Just to remind you and taking you back to what Nolan had to say, our projected returns, we think that equities are the best place to be. And if we look at, we in fact favor local equities over global equities over the course of the next 12 months. The world has got into a cycle, as Nolan explained, where global interest rates are picking up. This will put some pressure on markets. We think there's going to be certainly the slow grind of the last 6 months or so, upward grind, we think is over. We think there'll be a lot more volatility. One has to be very company specific. But overall, we think the global market's going to return a below average return over the course of the next 12 months, but we'd certainly stick with our equity portfolios. Companies are doing incredibly well. The economies are pumping, and it's really just fighting the challenge between rising interest rates and that dynamic. The world is certainly favoring value assets, commodity markets, emerging markets, etc., and all of that plays into the South African mantra. So we're looking for about a 12% return from local equities. So as we move through this year, the US economy is pumping, but obviously inflation is at highs, at 40-year highs. And you've got a completely different equation around the world, where in the US interest rates are rising, and in China they're stimulating and reducing interest rates. So you've got some very difference in changing dynamics. And as we said, that plays through into the South African story. The market is certainly looking through COVID. The one thing we know about COVID is that we can't predict what path it takes, but certainly the consensus view and what's reflected in shares is that things will start to return to normal. So that is another risk we would kind of keep our eyes on. I think in summary, from a global point of view, the risk-reward equation, because of valuations, is less attractive than it was 12 months ago, and that's something that we've got to take into account. So here we've got these contrasting cycles. And I think very important to understand that certainly especially in the last 6 months of last year, it was the value shares that came through, energy shares, financials, etc., and the growth shares, the companies that we tend to favor and tend to deliver the returns over time, came under a lot of pressure. So while developed markets in the States, the returns are over 20%, emerging market returns were negative, and we've seen exactly the opposite of that over the course of this year. I think the backdrop and what we need to understand is that growth is incredibly strong out there. A 3% drop in 2020, followed by a 6% growth. And Nolan's gone through, that kind of strong global GDP growth story. And certainly at the beginning of COVID, nobody would have expected this outcome. We expect another strong year in 2022, and then kind of returning back to normal. So companies as a whole have got a very positive backdrop to fall on. S&P earnings growth Remember, the US is about 65% of global stock markets. You can see the earnings growth in 2021 will land up at about 50%. Now, at the beginning of the year, the expectation was a recovery of everything that went down in 2020 and about 30% growth. So the growth and the recovery was significantly more, and that's where you saw a big rise in share prices. Again, in 2022, we're expecting about 20% earnings growth in the US. A lot of companies hadn't fully recovered in 2021, and they're returning back to normal. So that looks fantastic. And it's a strong argument as to why to stay invested in the market. There's strong growth coming through. And a lot of the growth companies that we own, we think have got great 5-year outlooks. But a lot of them are going through a wobble at the moment as interest rates go up. And what we call long duration assets. That means a lot of the value of the share sits in the growth in 5 and 10 years' time. And if interest rates are higher, the value of the value of money in 10 years' time is obviously lower. And hence you see the valuations getting squeezed. I think this is a very nice graph to show. This is the earnings growth in the S&P. So this is the earnings base of the US market. And you can see how that dipped in 2020 from 150 to 122. At that point in time, people were saying, can we get back to 2019? And we landed up significantly ahead of 2019. But we see earnings growth being sustained for quite some time at an attractive rate. So these are good conditions for companies. But the market has got very expensive. It's priced in quite a lot of this. So our kind of baseline view from a global perspective is that you're going to have a year of share prices absorbing the valuation and not reflecting the extent of the earnings growth. This is shown in the MSCI World Forward PE multiple. So this takes into account the strong growth for the next 12 months. And you can see it's still very much above average. We do expect bond yields and interest rates to stay at low levels relative to the past. So while everybody talks about rising interest rates in the US, to put it in context, interest rates are basically zero at the moment, and people are talking about them going to 1%. Now, if you go back in history, that got up to 3 or 4%. But the world simply, because of the debt that governments have taken on, they simply can't put interest rates up as much as they did historically. So interest rates are likely to remain low relative to history, which is positive for valuations. It justifies above average valuations. But we think that, a lot of the good news is already priced into the markets, and you have to look at individual shares. Emerging markets, by contrast, valuations are trading below average. A lot of this was driven by China last year, where China had a bit of a wobble. A lot of it self-inflicted, where they came out with lots of regulatory rules and the like. Commodities kind of flatlined a bit off very high levels. And what we're seeing this year and what we expect to see sustained is a pretty good performance out of emerging markets. China's stimulating their economy. They're trying to grow. They need to get back on their growth path. Last year was about 4% growth. They need to get back to the 5.5. So that's going to be a very positive influence. We think the Chinese technology story, a lot of their regulatory stuff has now been done. And it's very positive for commodity markets. Yeah, so we then get to, so you've had a huge drop in the tech shares, especially the expensive ones. But we got just a reminder that there's real value, and the secular trend of technology and the value of these businesses is something you really have to be invested in over the course of the next 3 to 5 years. We had a company like Activision Blizzard, which is one of the top 7 gaming companies in the world. And that price came under massive pressure over the course of last year, largely for internal reasons. The price went from about $100 down to almost $50. And many of you who've had these kind of highly priced tech shares and portfolios have seen massive drops. But some confirmation of the underlying value that sits in these businesses is Microsoft saw this an opportunity, and they came out and they've made an offer of about $95 a share for Activision Blizzard. So the price went up 30% and it's got another 10% in it. Interesting just to look at the top online gaming revenues around the world. Tencent is top, Microsoft was 4th, and Activision Blizzard sitting at around 7. So that would make it Microsoft the second biggest gaming company in the world. And it's remarkable to think that, a lot of us associate Microsoft with Word and Excel and the like, how they've adapted into a company in the gaming space. And obviously, as this whole metaverse concept comes to pass, where people will spend more time in a much more digitally sophisticated way in the digital universe as opposed to the physical universe, Microsoft want to make sure that they're positioned. So what do we learn from something like this is, we should have confidence that the high growth companies, in our tech fund, the revenue growth of the businesses that we own is probably sitting at 20 to 25% for the next few years. No doubt, especially the non-profitable ones, and Seleho will talk more about that, got overvalued, but there's some very strong underlying value and cash flows. And to look at a sector that's done very well, the bank stocks in the States had a phenomenal 2021 and in fact beat the S&P. But I think if you look at, where a lot of us in our portfolios weren't really feeling the uptick in the S&P, this has in fact been flat for about 9 months. So people realized that interest rates would rise, and share markets and shares about what is priced into something. So you've seen kind of a flat performance over the course of the last 9 months. But in line with what Nolan was saying about growing economies, this is bank profits in over the course of the last 10 years. And you can see that they reached record highs in 2021. A lot of this was about trading profits and all the listing activity. So the line of the ones that did really well were the likes of Goldman Sachs and JP and Morgan Stanley. But after the shares have gone sideways now for about 9 months, interest rates are very positive for banks. They earn more money on their own capital. They tend to earn a higher margin. And when we talk about the value stocks doing well, banks still sit in that value category. So whereas the S&P is sitting at 25, 26 times PE, the banks are sitting at closer to kind of the 10 to 14 times. So we like the banks. We're exposed to them in our portfolios, but much more the ones that are kind of core lenders, because it's the core lending business that's going to be much more profitable over the course of the next while. So the likes of JP Morgan, as opposed to the trading and activity and banks that have benefited from all the corporate activity out there. Then I just wanted to talk, to give you an example, we talk about all these indexes and how all that works, but ultimately we invest in shares. And there's very different pictures for all of these shares. And I thought Nike, this is literally from our investment presentation yesterday internally, gave an indication of a lot of the trends that are out there. So Nike is a share that we've owned and profited on remarkably over the course of the last few years. It's come under pressure recently from around the 170 level to around the 140, 150. But it's a business that we're probably likely to own for the course of the next 3 or 5 years. But it's going to look disappointing for a time period in an investment portfolio. But, we don't believe the way to invest is to bail out of Nike, change the philosophy, buy energy shares, try and get in at the right time. And Mike Gresty, following on later on, will take you through our thinking and how we approach these things. So there's no doubt that the impact of lower interest rates was reflected in Nike. So the price got quite elevated. The other theme is the dominant players are becoming more dominant. The cash flows that businesses and good brands have got to put behind their money puts them in that space. And the businesses that can play in the new world. So what Nike have done, and the big driver behind their business, is going from retail stores to online. So instead of a retailer making a margin out of their product, they're taking it online to the consumer, and that sits at about 30, 35% of their business. So that's resulted in Nike having a very high sustainable growth rate. We think they can grow earnings at 10 to 15% for the next 5 years, and that's certainly their target. And we think this is probably the best retail brand in terms of direct to consumer on the market. So Nike is a great example of supply chain issues. They obviously get a lot of their products from China. This is an extract from their presentation, where effectively they're saying they expected all these supply chain issues. And when we talk supply chain, it's the speed at which you can get a product from China through to the customer. So ports have been congested. COVID has meant it takes a lot more time to offload stuff with all of the COVID controls. There's been labor shortages, and people have been stocking up, and things have really got frozen. And even now, they're saying that they were expecting kind of double-digit growth as that supply chain recovered, but they're expecting that actually to be kicked out. It's going to take another 3 to 6 months. And this is also driving global inflation and prices. So this is an extract from their revenues. And if we just focus on what we've circled there, you can see that in the last quarter, the Chinese revenue is down 25%. So supply chain issues came to pass. So Nike as a whole had no revenue growth in the last quarter. Strong growth in the rest of the world, and China's 16% of their global sales and a big growth engine. And you can see on the right-hand side there, it was growing at kind of 10 to 25%. But the whole world has gone through this period over the course of the last 12 months, and it will start to normalize over the course of the next 12 months, where everything's been disrupted and you've seen different patterns in different places. So what happens going forward? So the Nike share price has come under some pressure. We're not very positive about where it goes over the next 6 months, but is this a share we want to own for the next 3 years? And the blue lines are the expected earnings growth. Blue is this coming year, red is the following year, and green is the following year. So we're expecting 30% earnings growth, and then 16% earnings growth and kind of normalizing at the 10 to 12. So Nike is a business with a fantastic return. When you look back over a 10-year period, they will have grown their earnings by 15 to 20% per annum, but the whole world is going through a wobble, and that's why it's not just about looking at indexes, it's about understanding individual businesses and looking at the opportunities there. So that's kind of the story on global markets. The value shares are no doubt kind of the place to be at the moment. Growth shares have come under some pressure because you've had inflation and interest rate kicking up. Quite a bit of that, you're probably getting to a point where a lot of that is factored in. There's some opportunities arising, and we're quite excited about how we navigate this year. And I think, unlike the last 2 years, we're going to get opportunities to buy some fantastic businesses at reasonable prices. So you've had the value segment of the market coming through, and a lot of that plays into the South African market. So, we certainly don't think you're going to get better returns out of local equities and global equities over the course of the next 3 and 5 years. But for the next 12 months, we're pretty excited about it. So last year was a 27% return. Sorry, that's 2021. We're projecting a 12% return over the course of 2022. And important to note that the JSE is actually more of a play on China than South Africa. About 35% of the market is resources. Those are booming at the moment. You've got to have exposure there. About 15% is NASPAS. The driver there is largely China. So that's 55% of your market. You've then got about 15% in Rand hedges, the Richemont, the British American tobaccos, which have very little to do with South Africa. So you've got that kind of 35 to 40%, which is the South African component. But even there, those really fit into the kind of value category. And I'll take you through some of those examples. So the domestic shares are in solid recovery mode. We had some amazing figures come out this morning from the retailers, from Foschini and from Mr. Price, seeing way more than expected growth coming through as people have hoarded cash. They've got the opportunity to spend it now, and they're much more confident about the future. And economies and shares are very much about consumer confidence and how people feel about the future. Local property, we think you'll get a reasonable return on. We haven't spent a lot of time on it in this presentation, but it's now much more predictable what will come through from a dividend perspective. And you can put together a fairly nice bundle of local property companies, including the offshore stuff in our local markets at kind of an 8 to 10% dividend yield. So commodity prices, which were kind of flatlining up until COVID, they then took a big dive, and they've literally doubled from the top. And you can see that they kind of reached peak levels, depending on the commodity, between Feb and March last year, and then kind of went sideways. And we're now starting to see another kick up as China is stimulating, and particularly the energy shares, where we're seeing energy and oil forecasts of between $80 and $120 over the course of the next 12 months. So hence we've retained our exposure to Sasol, where these supply chain issues are not going away. And in the old world energy stuff, everybody's preparing for new age, wind, solar, etc. They haven't invested in oil and coal and the like. So we're seeing short-term pressure and massive share price rises. So commodities, we think, are an opportunity. You've got to have exposure in markets that are still trading at pretty good values. Then we go through into our domestic segment, where compared to the rest of the world, our shares are still trading at very attractive multiples. So if you focus here, the 12-month forward PE multiples in our banking shares, First Rand, which is the quality one, sitting at 11, Capitec, you'd really put in a kind of completely different category from a banking perspective because of its different exposures. But the standard banks, Barclays, Nedbanks, Investex, trading at kind of 6-7 PE multiples and 6 to 7% dividend yields. So in aggregate, these businesses will battle to grow meaningfully over the course of the next 5 years. They're very much a function of the SA economy, and we're only expecting GDP growth of kind of 1 to 1.5%. But right now, where the world is looking for value, they're all going to show very good earnings growth for the next year or two. There's a lot more recovery still to come through. So you also want to have some exposure to these. So this is in stark contrast to the rest of the world where things have been pumping, valuations are high, and a lot of it is priced into the shares. In any SA presentation, you've got to talk about NASPAS. So while almost everything else was up 15 to 20% last year, NASPAS and Process were down 18%. So tied into the China story and the global recovery, and China just wanting to get on with business and stimulate the economy, we think that's going to flow through into a good year for NASPAS and Process. To look at the basic facts that one always has to look at when you analyze NASPAS, the discount to NAV is close to a record. I think everybody's exhausted with that story, but I think you from this level you're only going to get a positive rather than a negative for that. We've kind of lost hope that that's going to narrow dramatically in the short term. The 10-cent valuation, which is about 70% of NASPAS, is depressed. You can look at the blue line here. It's pretty much the lowest multiple it's been for the course of the last 20 years. So if anything, that can kick up. We still think 10-cent is a fantastic growth story. If you want to follow the whole metaverse and kind of new age technologies, 10-cent is probably the best placed of all the big tech companies out there. And then the actual NASPAS rump, the other 30% of it, which the market has kind of written off, that's what's implied by the discount, has been growing very nicely. And they think they can continue to grow that at 20% per annum at a faster rate than 10-cent. So the NASPAS story, we would certainly, and in our portfolios, we're overweight for the course of the year. Right, so quickly look at our equity top holdings, and you'll see a lot of the stories that we've been telling flowing through into the actual shares, Process and NASPAS. We like the COVID recovery story, which is a Bidcorp one. We really like great management teams that can allocate capital well, and Bidcorp, Transaction Capital, Afrimat all fall into that. Richemont's been a massive beneficiary of this kind of revenge spending. The numbers that came through a few days ago, their jewelry sales are up more than 27% on pre-COVID. So there's a lot of money out there shifted from services into this space. And with markets having done very well over the course of the last 2 years, and there's a lot of free money in the system. Murray & Roberts, the SA kind of construction story we think will come through. They, in fact, don't have that much exposure to it. That's more of a Wilson Bailey type story. It's come through in Robex. But Murray & Roberts is something that we think is ignored, and it's got some nice upside. Multi-Choice Spa and Tegela on the coal side. It's remarkable what thermal coal has done. Kind of a reasonable average price is $60 to $80. It's now sitting at about $170. So there's, we're playing the commodities. There's quite a lot of commodity shares that we own below this in smaller proportions, but that's how we're playing that. So to summarize the message that we're sending, you've really got the developed world tightening and some pressure on companies and spending, some risks that earnings growth comes down, and global valuations trading at quite high levels. So that could come under some pressure. And while economies are strong, we think quite a bit is built into valuation, and the risk-return equation is higher than average. So we're projecting a kind of 5-6% return from equities, which will then probably thereafter get back to a normal level. And there'll be some attractive opportunities during the year as that kind of levels out. The value and emerging market China stimulus type equation is all very positive and plays into the South African market and the trends coming through. The dividend yields of commodities and banks are sitting, as we showed you, at kind of 6 to 8%. So when we give a 12% return expectation, that's heavily underpinned by the cash you're actually going to get from the shares. NASPAS has got an attractive risk-reward equation. and we project a 12% 1-year return. So that's the equity story. I think we think you can still make money this year, but you have to be alert and on your toes. We're now going to pass over to Seleho. Seleho's been with us for must be now 6 or 7 years. He's very active in resources and the tech space, and he's going to educate us as what to think of the tech space, which has been very profitable, and what to think going forward.
Thank you, Pete. Yes, so I'm going to do a little review of technology, the year we've had in 2021, and look forward a bit and think about what we can expect going forward in 2022. There are really two main messages I want to communicate about the year that we've had in tech. And the first is that it's really been a year of divergence. That's a word that's going to come up quite a few times in my presentation. And by divergence, I mean divergence in returns. So depending on where within the sector you were invested, you would have had a very different return experience in 2021 and at the start of this year. And then secondly, we think that that divergence has started to, and over time should create opportunity. So in general, as volatility rises, you should start to see stock picking matter more and more, rather than just the market bailing everyone out. And we think that's going to be the case increasingly over the course of this year. So when I talk about divergence, there's a couple of ways of looking at it. The first that we're going to look at is divergence by geography. So if we think back to 2021 and look at the two major tech hubs in the world, the US and China, we had very different experiences between those two geographies. In China, as we know, last year, there was a significant amount of regulatory clampdown. In addition to that, we also had slowing operational momentum within these businesses. So you had revenue and earnings growth declining in several cases, and earnings downgrades coming through, as well as CapEx requirements rising in many of these cases. All of that combined resulted in investors really slashing the multiples or the valuations that they put on Chinese technology. And you can see that in the returns of major Chinese technology indices. So if you look at the NASDAQ Golden Dragon Index, that was down about 43%. The Hang Seng was down about 33%. And these numbers are really astonishing when you consider that those indices are being driven by some of the most dominant, profitable, and in some cases, innovative companies in the world. And it becomes even more staggering when you compare those returns to what we experienced in the US, where the NASDAQ was up 22% for the year. So at an index level, China underperformed US technology by about 50 to 60%. Which again is just staggering when you consider the size of some of the largest companies within all of these indices. So again, by geography, you had really significant divergence in 2021. And I'd say that's the first point of divergence worth keeping in mind. But even if we have a look at this 22% return from the NASDAQ, I think that's a little bit misleading within itself, because you can look at that and think, okay, well, at least US technology had a relatively good year, 22%. I'll take that every day of the week. But that 22% really doesn't communicate what was happening beneath the hood or beneath the surface. So yes, we did have a good return at an index level from US tech or from the NASDAQ. But if you peek beneath the hood and look at what happened with unprofitable tech in 2021, you see just a very different story. So unprofitable tech was down about 30% in 2021, as measured by this Goldman Sachs non-profitable tech index. And a lot of that underperformance really came through in the fourth quarter. So what really happened is you had the NASDAQ being driven forward by the largest, most profitable, dominant, well-established companies. That's what drove the index forward. But underneath that, if you look at this Goldman Sachs non-profitable tech index, the smaller, more emerging, less dominant, more speculative parts of the technology market, that part of the market really struggled. And as I said, the underperformance really came through to a greater degree in the fourth quarter of 2021. As Nolan mentioned earlier in the presentation, this phenomena of rising inflation and rising yields has become a topic of great focus recently within markets. And that's particularly negative for that more speculative part of the technology market. So this would be the second point of divergence that I would like to highlight, is that first, we highlighted between US and China. Yes, there was significant underperformance of Chinese technology. But even if you look within the US, it was really large cap US technology businesses that drove indices higher within the US. Mid cap technology really came under pressure last year and at the start of this year, as we'll see. Okay, so where do we stand today? We've had a look at what's happened over the last 12 months or so in 2021 in technology, but what does that mean for us today? This is a very simple way of looking at where we stand. So as of roughly today, in the NASDAQ, about 43% of that index, of the members of that index, are down at least 50% from their 52-week high. So they've had really significant, massive drawdowns from their 52-week highs. And just to put that into context, if you look at the S&P 500, only about 1% of the S&P 500 has had its members down at least 50% from their 52-week high numbers. So you can see that within technology, this word I'll use again, divergence or volatility has been really prevalent. It's really been there within the tech sector. And this, in theory, should start to present opportunity. So I think going forward, the challenge or what we really need to focus on as investors is sifting through and distinguishing between cases where the sell-off was justified in a stock, and if you look at the fundamentals or operations, it makes sense, and cases where perhaps the sell-off isn't as justified and we might actually have an opportunity. Part of the challenge for the tech sector has been that in 2020, it benefited to such a great degree from the start of the pandemic as we all went into lockdown. But then in 2021, 2020 turned out to be a very high base from which it's been difficult to grow off of. And that's presented a challenge operationally for large parts of the tech sector. And I've got a few examples to illustrate this. One very simple way of illustrating this is US e-commerce penetration. So if we look here at the start of 2020, we had a massive spike in US e-commerce penetration as people were staying home, and e-commerce was a convenient way of shopping, given the lockdown restrictions at the time. And if we think back to roughly the start of 2020, that first and second quarter, we had many CEOs within the e-commerce part of the market saying that we had pulled forward demand by a few years. So the idea was we were going to grow off of this higher base. We had structurally shifted the level of e-commerce penetration, and we were not going to return back to where we were pre-pandemic. It turns out with hindsight, that was too optimistic. We've seen I don't know if you can see my cursor here, but we've seen the level of e-commerce penetration kind of normalize back to the long-term trend. So pre-pandemic in the US, they were adding roughly 1% to 2% in e-commerce penetration per year. And it looks like we're going back to that trend as lockdown restrictions have started to ease in the US, and I would argue globally as well. The challenge has been for US e-commerce players, that 2020 level of demand has actually proven to be a bit of a hindrance in hindsight, in the sense that it's made 2021 and potentially 2022 earnings numbers very difficult in terms of growth. So it's been difficult for them to grow off of that high base that we had at the start of the pandemic. Having said that, we do think that over time, e-commerce penetration, not just in the US, but globally, should continue to rise at a structural level. So we don't think that this normalization is going to break the trend that we've seen in growth of e-commerce penetration. But clearly in the short term, there are challenges for the sector. One other example I'll give, which is pretty topical given that Netflix reported last night, is video streaming. So if you look at TV viewing by platform in the US, it's important to keep in mind, although for many of us, Netflix or services like it might be the only TV we watch, actually in the US, roughly 2/3 of TV viewing is still traditional linear TV. So that's cable TV, which is 40%, and broadcast TV, which is 23%. That's still the majority of the way that people watch TV in the US and globally. Streaming is only about a quarter of TV viewing in the US. Now, similarly to what we said with e-commerce penetration, we've seen video streaming have a similar sort of trajectory in the sense of in 2020, they benefited massively as people were staying home, probably watching more Netflix than they should have been. And then in 2021, you started to see that 2020 base become a challenge in terms of actually growing off of that base. So initially, some market participants started to think that we could grow off of that 2020 base, and we had a structurally higher base. Clearly, that's not been the case. And last night, Netflix reported, and although the actual numbers for the fourth quarter of 2021 were good, their guidance for the first quarter of this year, of 2022, really disappointed the market in terms of subscriber additions. And so I think this is another case where, although we do expect video streaming to grow as a proportion of total TV viewing, not just in the US, but globally, we do expect that to grow over time. Clearly, in the short term, there are challenges. Year-over-year growth numbers are going to be challenging, and actually adding subscribers is going to be challenging for not just Netflix, but the likes of Disney Plus as well. So I think today where we stand is we're in a situation where we're going to be sifting through the rubble or searching through the rubble. And that's a theme that we've started the year off with. And I think to a greater degree, as we go through the year, that's something that we're going to be keeping in mind. I mentioned some of the ways in which the returns within the technology sector have diverged. And again, as that volatility increases, it should in general result in stock picking becoming more and more important. And really what's important is going to be distinguishing between cases where sell-offs in shares have been justified and where they haven't. Because as one of those earlier slides showed, we're now sitting in a position where about 40%, I think 43% is the number, of the NASDAQ is down at least 50% from their 52-week highs. So there is a significant amount of volatility that we've seen within the tech sector already. That volatility might even rise over the course of the year. And it's really about sifting through that rubble now and seeing where there is opportunity. That's the end of my section. My colleague, Mike Gresty, is now going to go through the process of how we actually look at businesses and what we're actually looking for when we're looking for investment opportunities. So I'll hand it over to Mike now.
So yes, thank you. Sorry, it's been a fairly long presentation. I'm just going to spend a couple of minutes to take us through to the conclusion, talking about our investment approach. And, why are we doing that? Probably to pull two things out of the discussion that we've had so far would be Pete's comment that we're really entering now potentially quite a volatile and tricky phase after a lengthy period in which it's felt like, the tides lifted all boats. And then, Seleho's point that, this is going to really be a period of stock picking. So I think for investors, we're really into a phase now where you're going to have to understand the approach that your fund managers are using in their stock selection and decide whether it resonates with how you see the world. So now let's just step into that. First of all, before we even get there, I think it's incredibly important to understand what is it that we set out to deliver for clients. There it is at the top there. We're seeking to grow clients' assets in real terms, so above inflation, in a consistent manner. So we are, of course, investing in equities here where there's going to be a degree of volatility. But for us, an outcome we're looking for is one in which, we manage that volatility. And I hope you will see as I explain our approach, how we achieve that. Something else that came through from Seleho's presentation is the very different experience you got looking at the index level outcomes versus what was happening below the bonnet. And what we've seen, particularly in the back end of last year, is how, benchmark performance, market performance looked reasonably good, but there were all sorts of other things going on below the surface. And, really what's happened in recent times is that indices have become incredibly dependent on the performance of a couple of big stocks. One of the interesting stats that I saw recently was the fact that although the NASDAQ Composite Index has almost 3,200 stocks, in excess of 40% of the valuation and performance of that index is driven by just 10. And when you think about that, you start to appreciate just how concentrated and potentially risky these indices have become. I think in South Africa, we're quite familiar with that. We had at one point the situation where Naspers and Prosus together were well in excess of 20% of our market. Of course, that's fantastic when they're performing well and there's been a rush into these big cap stocks. But I'm sure you can appreciate that probably is not something that can continue indefinitely. And ultimately, it comes down to fundamentals. Another important thing that I think is going to be tested over the next couple of years as we see possibly a more tricky investment environment than we've been through is the fund manager disciplined enough to stick to their investment principles through adversity? Can be a very lonely experience when the market's moving against you. So no doubt that's going to be tested. Turning then to our approach, at its absolute heart, what we are looking for is companies that generate high returns on capital. So these are quality businesses. They are certainly not cheap. The market recognizes that these are quality businesses. So in an environment where very much the focus seems to be on value, we appreciate that it could be a challenging time for us. But as I say, this is why what we are looking for here is essentially companies that benefit from, what Einstein was quoted as referring to as the eighth wonder of the world, being that power of compounding. So we're looking for businesses that have great growth opportunities. It's not just about generating high returns on capital alone. It's the ability to reinvest that capital at similarly high rates of return. And that's where that power of compounding comes through. Other subsets of that, we're typically looking for businesses that have almost won, essentially. They're reinvesting their capital in strengthening their competitive moats. They are strengthening their position. It's not by accident that they generate those high returns. The rules of finance are that where businesses are generating high returns, typically it brings in competition and those are eroded away. So we're very sensitive about how that changes over time. And that leads us into the last point. If you don't innovate, you die. So we're really looking for, management teams that have developed a track record of an ability to see changing market conditions. We're seeing creative destruction coming through at an ever accelerating pace. Been some really interesting developments within the technology space, for example, this year with the likes of Facebook evolving into its next big call being the metaverse. Some controversy around that, but increasingly, I think we're seeing, perhaps Microsoft now beginning to emulate that with its recent Activision Blizzard acquisition. So, as I say, we're looking for businesses that are moving with the times. They're not just essentially management teams taking big bonuses as kind of occupiers of the C-suite. And how does that actually operate in practice? I think, first of all, it's obviously fairly self-intuitive, I suppose you could call it, that highly compounding businesses are growing well. So in good times, that's going to result in a great return. But in terms of that stability through time, it's important to understand that in more negative economic conditions, these are businesses that will survive. They've got high margins, well-managed, strong franchises. You contrast that with weak businesses. We saw a lot of these sorts of businesses fall over during the early stages of COVID. The problem you sit with there is you never get the opportunity to benefit from a recovery in the market of these businesses go to zero. So essentially, we accept that during market corrections, highly rated quality shares will not be immune to that. But the important point is that they will survive, they will recover. They're businesses that benefit from time. That compounding and that growth, if your rating is high, over time does unwind. Now, how has that worked through time? What I'm showing here in this chart is essentially just the total return. So that's the price return plus dividends of a selection of stocks. The blue lines are some classic high ROCE compounders that you would expect to see in your portfolio if you invest here at Anchor. The red and brown lines are a selection of lower return businesses. And I've been quite careful in the ones that I've selected here. So I've taken Ford as a kind of, can I call it a smokestack industrial business. I've taken Newmont, which is the big gold mining business, obviously very topical. Where's the market on gold? and there are obviously very polarized views on investing in gold. And finally, I've taken a green energy business, obviously been very topical in recent times as the world transitions to green energy. Vestas is probably the biggest wind turbine maker. Now, what you see here is, despite a number of these lower return businesses being, in a sense, quite interesting story stocks, be it gold or green energy, ultimately it's the numbers that win out. And these have all been quite low return on capital businesses. When we contrast that with these high return classic compounders able to reinvest in growth opportunities, you can see how they have absolutely trounced the low return businesses over time. And that's really what we're seeking to form the core of our portfolios with. And you can see how over time those have went out. Now, looking at it slightly differently, I've taken a selection of, again, some other classic compounders that we would expect you to see in your portfolios, and then contrasted them with a selection of other businesses that are actually quite high return businesses, but not really reinvesting. They're not reinvesting that capital in their businesses. Big dividend payers, and again, in a certain context, there's nothing wrong with that. But just what I wanted to show you is that magic of compounding, the ability to reinvest in growth, and how that's really started to come through. And perhaps one to particularly single out there would be Moncler, which is the Italian luxury fashion brand. And it only listed in sort of late 2013, so it's got off to a pretty late start. And you can already see how, this power of compounding of returns has already enabled it to deliver, total return performance comfortably in excess of some of those lower return businesses. So just to wrap up, if you've looked through all of the commentary about how one should be positioned, there's all sorts of themes out there, and each one of them really, in a sense, makes incredibly good logical sense. Obviously the opening up trade, we've had a few false starts around that, but will airlines perform this year? Certainly that's, cruise liners. Yes, certainly potentially that could be an interesting idea. Rising interest rates, definitely seeing value outperforming at the moment. Looks like it's a good time for banks. China, after a difficult year last year, could definitely outperform. And Pete highlighted how interesting it is from a counter-cyclical perspective. And while we are not kind of immune to these ideas, we tend to think of them more peripherally, battle to get that out, around our core philosophy. And we'll really be using this time to continue to do what we've always been doing, looking at potential pullbacks as opportunities to add to these quality compounders. And as Seleho, highlighted, we've already seen some big corrections in a number of those opportunities. It's at times like this when you tend to get a kind of risk indifferent sell-off across, all companies that fit a particular theme that's out of favor. And that presents fantastic opportunities for those that are, nimble and clear in what they're trying to do. So this is what I hope will be a very exciting time for us to pick up some of these great quality companies with our eye on performance over the next 3 to 5 years. So that's it from me. Thank you very much. I'm going to now just hand back to Pete and Nolan, and I think we've got a little bit of time for some questions. Thank you very much.